There's actually a saying, when you go to heaven, don't leave hell behind. Now, what does that actually mean? Most of the time, when people actually die of a sudden death, unprepared death, a lot of things are left scattered. And one of it is actually debts that they owe, and the burden actually falls onto their family. That is exactly what it means. When you go to heaven, don't leave hell behind. Don't leave the debts to your surviving beneficiaries to settle them. So in this video, I'm going to cover the third pillar of the financial hierarchy. And don't worry if you don't understand what the financial hierarchy is. I'll leave a link on the top right where I cover the first two pillars of the financial hierarchy and what the financial hierarchy really is. In this particular video, I'm going to talk about the third hierarchy, which is the third pillar, which is actually debt cancellation, part of estate planning. And you can repurpose it for many things, a debt cancellation and a housing loan, or even an education plan for your kids. And I'm going to show you step by step how you're going to get there. Let's use a typical scenario for most Malaysians, not just Malaysians, anyone who buy their first home. So you go to the bank, unless you're well endowed, your parents probably gave you millions to buy a house. Most of us actually have to go to the bank, get a mortgage. And when you get a mortgage, you actually collateralize your home to the bank. And they will also kind of force you to buy an insurance. And this normally comes in the form of a mortgage reducing term assurance, or MRTA. Now, I'll explain every single alphabet in that synonym or that abbreviation has a meaning, and I'll explain why and why is it important. So let's just say you took a housing loan of 500,000 ringgit. And the loan tenure is actually 30 years, right? So it's not exactly how it looks like this, a straight line coming down. It actually looks more like a flattish plateau and then a curve going downwards. But at the end of 30 years, it actually goes to a zero on the x-axis because you finish paying off your loan and your principal and your interest, right? But for simplicity's sake, I'll just draw a straight line going downwards. That means 500,000 loan, you pay your interest, you pay your principal, and it reduces over 30 years, and it becomes zero at the end of the day, right? Now, let's just say the bank also asks you to take an MRTA that is 30 years, right? To cover the entire tenure of the loan. Mr. A, he was 30 years old when he took this loan, and he'll be 60 by the time he finished paying off this loan, as well as the MRTA coverage, right? By happenstance, Mr. A passed away. In the first scenario, Mr. A passed away at 48 years old. Now, how does the MRTA benefit him? Because the MRTA covers for death and total permanent disability. The moment that occurs, Mr. A's Mr. A's beneficiary don't get the money first. The bank, which owns the property, will get the insurance payout. Okay. And if there is a balance, then the balance will be credited to the beneficiary. Now remember, it doesn't come to the beneficiary directly because the bank actually owns the MRTA. The bank actually owns the property in lieu of you finishing off your loan. So therefore, the bank owns everything, right? So in this scenario, Mr. A is kind of lucky because the bank gets paid from the insurer. Usually the insurers, they'll own a subsidiary. I'll share with you more later. And the beneficiaries or the people who are still staying in the house gets to own the house for kind of free because the coverage is there, right? Now, what happens if 3 years prior to Mr. A's death, he actually contracted cancer? At 45, he contracted cancer prior to death at 48. Now, in this scenario, will the MRTA actually help him? I paused for a while for you to just sink in and think about it. Actually, it doesn't, and I'll tell you why. Because MRTA only covers for death and total permanent disability only. It does not have coverage for critical illness, and therefore there's no payout. And in this case, the MRTA didn't help Mr. A at all. So at 45, when he contracted cancer, and prior to his death, in the 3 years prior to his death at 48, he still had to continue paying his housing loan. Even though he may have lost his job and may have lost his income, he still had to finance the installment of the loan. And therefore, MRTA in this instance does not help in kind of like his debt cancellation. It only helped him upon his death or a total permanent disability. There's one more big disadvantage of taking an MRTA plan, and I'm going to share with you this little loophole. So most people who start off buying their first property, they're taking almost full financing, 90%, and they do not have the cash means to actually pay up another big chunk of amount of money. And usually MRTA is a single premium paid upfront at the beginning of the tenure of the protection. So for a 500,000 loan and protecting over 30 years, usually the MRTA is anywhere between 20 to 30,000 ringgit. So the banks would, pun intended, the banks would gladly offer you, hey, want to park this MRTA financing as part of your loan, because they know that it's not easy to cough out the amount of money. Now think about it, you're paying interest rates for a 25,000 single premium MRTA and stretched over 30 years. And who are you financing, or what are you financing? You're financing an insurer and the bank to protect them, not you. Think about it, because the first beneficiary, if something happens to you, is actually the bank, who has ownership and collateralization of your property. So therefore, you're financing the bank, you're paying them interest, you're financing the bank to actually protect them. That's how I look at it. I mean, I'm just being as honest as possible. And when I realized this, as well as, oh my gosh, is there alternatives? Should there be an alternative that's much better? And, rather than being kind of like held ransom in this kind of arrangement. So there must be a solution that gives you greater assurance, better value for money, greater control, and greater flexibility. So one alternative, and I think one of the best alternatives, is this thing called an MLTA, or mortgage level term assurance. Okay, so what's the difference? Let me illustrate the same example. The same person, Mr. A, took a 500,000 loan, 30-year tenure, right? Same scenario as the previous one in the MRTA example. But instead of having a reducing coverage over 30 years, this coverage is level and increasing over that same period of time, 30 years. Now, this coverage increases for both death and TPD, and you can alternatively, you can include a rider or add-on that covers you for critical illness. Now, how do we know what is the right amount to add for critical illness? Very simple calculation. For a 500,000 loan, your loan installment over a 30-year loan period is roughly about 2,500. So if you take into account 3 years of installment, that's roughly about 100,000 ringgit. Okay. So Mr. A, remember, he passed on at 48 in the previous scenario, and he had cancer at 45. Let's re-illustrate the same scenario. But over and above, in the MRTA, he did not have the option of including the critical illness cover. In this particular MLTA plan, you can include this MLTA critical illness cover. So he included a 100,000 ringgit MLTA cover for critical illness. Same scenario, Mr. A had cancer at 45. Now, at this point, the critical illness benefit would trigger, and 100,000 in lump sum would be paid to Mr. A. Now, Mr. A, while nursing his illness, he can use this amount to continuously pay his installment over the next 3 years, right? Sad to say, Mr. A passed on at 48. Okay, same scenario as what happened to him before when I was using the MRTA illustration. So, on his passing at 48 years old, remember at 45 he already got paid one lump sum, 100,000 for his critical illness. At 48. He passed on 3 years later. His death coverage will not be the reduced amount of where the loan amortization is. It would be at the amount where this level is increasing. So you can see the blue line on top and the arrow pointing out to it. So the coverage started at 500,000, but because it grew bit on bit every year, roughly about 1%, simple growth over 30 years, 1%, 1%, 1%. At the point of his death at 48, his coverage amount would have been roughly about 520,000. Okay? Now, these are all just illustrative numbers. Obviously, different people, different age will cover differently, but the concept is the coverage would increase year on year roughly about 1%. Okay? So upon Mr. A's death, 520,000 payout. The loan amount at that point is 250,000. So the beneficiary of Mr. A can take, and it doesn't pay the bank first because MLTA is assigned to the person. The person is insured, not the bank becomes the beneficiary. Okay, so straight away the payment goes to the beneficiary, 520,000. The beneficiary can take that 520,000, pay off the remaining loan of 250,000, and the balance of 270,000 belongs to the beneficiary. He or she can use that money as they please. Now see the huge difference. MRTA, beneficiary is the bank. Straight away you pay it out to the bank because the insurer or set it up in that manner. But an MLTA is assigned to the person and his beneficiaries. So the beneficiaries upon his death get first dips into the money first. Then he or she can decide to pay off the remaining loan, and whatever balance it's she or he can spend as they please, right? Completely different flexibility, control, and alternative. Now, this is an illustration of a male non-smoker, 30 years old, and I'm not going to go through in detail all the numbers, obviously, but what I wanted to show you is this. By right, the MRTA looks cheaper upfront because you're paying one lump sum at the beginning of the loan tenure, and you don't have to pay anything else. So if you see column MRTA, I'm going to highlight it now, right? If you see column where on the blue column MRTA, you will see that under 21,000 premium paid 21,635, right? Death coverage 500,000. So as you go down along the table, you will notice that the coverage actually reduces. Now, what does that mean? Remember the line, the MRTA line that I showed you earlier? So your coverage reduces following the amortization table of your loan, right? If you started this MRTA policy at 35 years old, the premium you would have to pay is more expensive. It's 26,000 instead of 21,000 starting at 30. And then as you age at 40 years old, the premium increases some more because the mortality rate is different. So it's 30,000. So the point I'm trying to highlight is this. You pay a single premium at the beginning of the tenure, and it only covers for reducing death or TPD coverage. Now, contrast that to MLTA. It looks like you're paying more premiums. So if you follow premium column A, 3,000 a year, is 3,000 a year for the next 20 years. So 3,000 first year, 6,000 is cumulative lah. The amount that you see is cumulative. 3,000, then 3,000, then 3,000. So it's 3, 6, 9, 12, 15. You pay for 20 years all the way until the 20th policy anniversary. In total, cumulative, you would have paid 60,000. But in contrast to MRTA, look at your death coverage, your death and TPD coverage. It's 500,000 and increasing every year until it hits almost 645,000 on the 30th year. Now, huge difference. Remember that blue line that kept on increasing? So death coverage increasing 1% every year, death and TPD coverage, okay? Now remember, Mr. A also took an option where he included critical illness of 100,000. So that line stays flat, 100,000 is a flat line. And last but not least, under MRTA, because it's a term plan, there is no cash value to it. Yeah, virtually you pay 21,000, protect you for 30 years, you don't get anything in return. For an MLTA plan, there is a residual cash value into the policy. So if you look at column B, you see cash value. You see 740 ringgit at the beginning. Then it goes all the way till roughly about the red line that says 69,528. So on the 20th year policy anniversary, your death and TPD coverage has increased all the way to 595,000. Your critical illness cover is still about 100,000. And on top of that, you have 69,000 of cash value within the policy itself. Now, can you withdraw it? Yes, you can. Obviously, there's some minimums that you have to keep inside the policy itself. But at that point of time, would you consider, if you net off your costs, you paid 60,000 total in premiums, the cash value of your policy is now 69,000. You would have gotten, in a way, a negative 9,000. That means you had extra 9,000 ringgit in your policy, and you got the policy kind of for free. So I know some people will argue, time value money, inflation is not really 60,000 whatsoever. But the main point is this: you've gotten a coverage for 595,000 death and TPD, 100,000 for critical illness, and your premiums, you have cash value that's more and above than the premiums you paid. So you kind of get a protection for free already, you know. And what I advise some of my previous clients to do is that if they have lots of surplus in this and they want to reduce their mortgage, they can withdraw some of this money, this cash value, and use it to actually reduce their loans. Because within the 20 years, right, anything would have happened to you, and you have been well protected in the scenarios I described, the examples I described earlier. But at the same time, if you're healthy, nothing happens to you, you can withdraw some of this cash to actually just pay down your debt. Now, isn't that killing many birds with one stone? So I like to summarize the huge difference between MRTA and MLTA. Now, MRTA, reducing benefit, no critical illness cover. The control really is within the bank. Everything you do, the bank actually gets first dibs. Here's another one. MRTA is really tied to one property. So you bought property in location A, you cannot transfer, you can, but the cost for you to transfer from property A to property B, let's just say you settled the entire loan amount for property A and you want to move this coverage to property B. The cost for you to transfer, might as well buy a new MRTA. So there's no flexibility in transfer of property or title. Okay. Now, MRTA also, you pay a lump sum, and then if you park into the loan, you have to serve interest. Now, contrast that to MLTA. Guaranteed benefits, 36 critical illness are options to be included. Who gets control? You're actually yourself or your family or your beneficiaries. It's not tied to a single property. I have some clients that actually buy MLTA enough for 4 properties. And let's just say A, B, C, D, property A, B, C, D. They decide to sell D, right? Do they need to get a new MLTA for property D if the loan amount is the same, the coverage amount is the same? They don't need to. They actually just buy property D and they say that, oh, I have enough because the MLTA amount is enough to cover the loan or the debts on property D. Okay, that's the beauty of MLTA. Interest-free installments, has cash value, and the cash value, ironically, can help you save certain years of your housing loan installments. I hope you benefited from this sharing. I mean, my eyes really opened up because I took a risky move that I didn't even realize was risky. I took an MRTA before knowing the benefits of MLTA from the current property that I stayed. And what I did was I took a shortened tenure of 5 years coverage. Now, what I didn't realize at that point of time was that I was exposing my family, my beneficiaries, to the remaining balance of the debt for the remaining 25 years. And I didn't know that impact until someone showed that to me. And I wish that you do not have this rude awakening. That's why I'm sharing this with you right now. And I hope that you are better, well equipped to understand the difference between MRTA, MLTA, especially for debt cancellation, estate planning. As I said, as I began with the beginning of the video, when you go to heaven, please don't leave hell behind. This is one of the tools that I really hope you can utilize to protect your family. And if you think you've benefited from this sharing, what I've taught you today, please subscribe to the channel, give me a like, give me feedback. If you want your policies to be reviewed, no promises, I'll try my best. Leave a link in the description for you to upload your policy details so that hopefully in one of these episodes, I can use it as a case study example. Obviously, your names will be redacted. I use it as a case study example to show people how to interpret that particular policy and whether it's suited for you. And I'll see you in the next video, guys. See you.